Thank you. Thanks for having me, Kwame, for the invite here. Always excited. And in addition to my role as a finance professor, I've been involved with the critical materials crossroads, which we were just hearing about, part of this NSF engines. And Tony got me involved with that about 3.5 years ago. And before that, my critical minerals and materials knowledge amounted to a 1 credit hour lab as an undergrad. So that was the background there. So the finance side is more where I'm coming from on this. So I've been helping think through the capital strategy around critical minerals and critical materials, and really focused on how or if, let's say, policy moves are impacting what we're seeing in the world of funding and investing in the critical minerals and critical materials space. So I don't think I'm really breaking any news with any of these, and in fact, I'm restating what I've heard from many of the speakers we've had in terms of as sort of a high level, what are some of the challenges that we see when trying to fund these projects. And maybe before I jump into that, it's worth noting that different projects at different stages of TRL or different stages upstream and downstream have their own specific challenges, but these factors generally hold. And one of the big issues is the life of these projects is long, and by long, I'm kind of comparing that to the world of private equity. So when you think about how private equity firms operate, they typically look to exit an investment within 3 to 7 years. And so the life of these projects is quite often well outside that time frame, which makes them not attractive. Another way of saying this is, if you look in the world of investors at the realm of all the things you can invest in, there are many industries and opportunities that have much quicker paybacks and cash flow much more quickly. And number two, are less capital intensive, right? So mining, refining, all parts of this process can be rather capital intensive. So that has historically kept private equity and the private investors a little bit apprehensive of this space. But maybe some of the bigger issues are really 3 and 4 in the challenges here. And so I teach financial modeling and building out cash flows for projects, and it's probably worth mentioning just how investors and finance people think, but it's pretty simple but not always easy. And the simple part is you just try to figure out where's the money going and how much money's coming back and when, and then you kind of square those up and see if it makes sense. But the top line of what the money's coming back is how much stuff are we selling and what are we selling it for? And in the case of minerals and materials, especially some materials have very volatile prices, and it's very difficult to know what kind of revenue you're going to be generating in 1 year, 3 years, 5 years, 10 years when you see these big moves. Even moves to the positive, like we saw tungsten up 600% in a relatively short period of time. That's good for the financial case, but that kind of volatility is often spooks investors who are thinking longer term here. We've heard a lot about number 4, but it's probably worth saying there is a reason why a lot of this processing was offshored in the first place, economic reasons. And there's a reason why perhaps we've been a little bit slow to reshore and onshore is just the underlying economics of some of these projects just don't make sense from a for-profit type of standpoint. And the fifth, regulatory hurdles, which we've heard more about here, but certainly that impacts the life of the projects and many of these other points up here. But I'm focusing on these areas to really highlight these are areas in which, let's say, policy has the ability to change the game a little bit and to relieve some of these constraints to attract private investment. And in cases in which that's not possible, of course, public investment is an option as well, too. So I'm going to kind of explore the range of fully public investment to fully private investment to sort of a hybrid of public and private as I move throughout here. But to me, a lot of times it comes back to the degree to which, let's say, these 5 constraints can be alleviated. Probably also worth saying, even though we've just seen it in some of the other presentations, the first time I gave a talk on capital in this space about 3 years ago, there's not nearly as much activity. So there's been a real increase in activity, which has been very encouraging to see, and hopefully we're ready to see that continue. So it's kind of a complex funding environment, and this slide just hits on some of the players in the space, again, ranging from public funders like the Department of Defense, Department of War, all the way to completely privately funded operations, including your kind of run-of-the-mill private equity and venture capital, corporate investments. Many corporations can self-fund. We've seen foreign governments get involved. We've seen the United States government take equity stakes, which is relatively unprecedented in this country's history in any industry, let alone in this particular industry. So we've seen a lot of different opportunities emerge. When I look at the federal government landscape as it impacts, let's say, how investors and funders are thinking about this space, I don't want to belabor what we've just heard from the other presentations, but I do think the Department of War's investment strategy, in particular, the Office of Strategic Capital, issued their investment strategy document last year. I'll hit a little bit more on that. But the Department of War's interest in critical minerals and critical materials has definitely caught the attention of investors and shapes the way that they're thinking about that. And one of the phrases that comes up is concern about adversarial control over quote-unquote raw materials. We've seen some efforts at the Office of Strategic Capital with a loan guarantee program that I'll unpack just a little bit more. Again, government equity stakes. And then number 5, we've seen, at least in some cases, price floors and offtake agreements, which to some extent solves, at least for a period of time, this issue of volatile sort of underlying minerals and materials. So we've seen a variety of solutions here. So this is just unpacking this Office of Strategic Capital document, which really lays out their strategy. And this is from the document of the 3 periods that they look at. But in the near term, they're focused on choke points and economic networks. It's interesting that their specific example that they used in this document was a mineral market, and it was at the point of refining with adversarial controls. So it's an issue of even when we mine in the U.S., we're shipping it to China, and the risk that presents. In the medium term, they use this phrase, they want to lower the cost of capital so domestic and allied production can scale. And it's one of those statements, I think I know what they're talking about, but I'm not totally sure what they're talking about. But from the cost of capital, what they're really talking about, I think, is lowering the risk to investors such that they are more attracted in scaling investment in this space. As Chris had said, China put in something like $150 billion into this space, and I think what we just heard from Danielle was maybe something like $7 billion in the last however long. So my back of the envelope tells me that leaves a lot of billions on the table that have not come forward here. And then I think the third addresses a little bit this idea that there are underlying economic reasons why a lot of refining and other activities were offshored in the first place, which is it's not as economical to do them in the United States. And so if that's going to change, it's probably going to be through innovation and through new processes, and that's probably going to take some time. And so the Office of Strategic Capital has these loans that are much longer term than conventional loans, recognizing that it's going to take a while to get from idea phase to commercialization in a lot of these spaces. So just to unpack this credit instrument, so they started with a roughly $1 billion pilot program. MP Materials got a $150 million loan, which is at the absolute upper limit of that particular program that they have. Their particular loan was a 12-year term, so that's quite a bit longer than a conventional loan would be. It's also for a pre-revenue idea, a 12-year loan that is basically at U.S. Treasuries plus one is a pretty good deal for a company. That type of opportunity has not really existed previously. I want to jump into some headlines from the Wall Street Journal for a variety of reasons. It's just going back roughly 1 year in time just to see what, let's say, the investor community is seeing in this space and the types of headlines that are making it to investor types and to Wall Street types of folks. And the first one we see going back about a year ago is China choking the supply of critical minerals to Western defense companies. And by October, this already turns into a headline that says America's hottest new investment, rare earth companies, right? So in a fairly short amount of time, this went from, again, we were seeing increased interest from private markets and private investors in the space to the hottest new investment here. And part of this is the posture of the federal government and especially the administration. And I think the belief that returning to a reliance on China for supply is not long-term sustainable. So this has drawn an interest from private investors in a new to a new scale, certainly. We started to see, even in November, more venture capital. This has come up in a few of the talks, more venture capital activity in the space. A few deals to kind of unpack here in a little bit of detail as we're going to start to get into how some of these mixing and matching of private and public types of efforts work. In November of 25, Vulcan ends up getting an equity stake from Commerce that actually came from CHIPS Act funding, but it resulted with Commerce actually owning a piece of Vulcan Elements. And so I'm going to return to this theme at the end, but again, the federal government taking equity stakes in U.S. publicly traded companies through a variety of entities is basically unprecedented, other than a couple of very extreme examples in our history, like you can think of GM and some other types of one-off types of investments. So also in November of 25, ReElement Technologies signs this conditional defense loan with warrants, and the conditional part turned out to be kind of important. I don't know if any of you have followed this, but July 16th, we figured out ReElement did not get this loan, right? So ReElement failed the diligence effort. We don't really know the backstory, or at least publicly we don't know the backstory of what went on there. So we've heard about the Korea Zinc deal, and the next set of headlines that really caught attention in the Wall Street Journal was around Project Vault. And so you saw that publicly traded mining companies and publicly traded minerals companies that could basically react to this news reacted very positively. So the public markets were very excited about this. And again, this $12 billion stockpile gets to this guaranteed demand type of issue that a lot of finance folks struggle with as you're trying to model these projects out to know that there's some support there longer term for the demand. We saw in March of this year, Orion raise over $2 billion fund for critical minerals. It's one of the largest extraction funds ever raised. So one thing that has held back, I would say, private investors in the past is the fact that we have not really historically invested in these types of projects in the United States. So there aren't any funds specifically geared to this theme, and now we're starting to see that change here. I wanted to talk about these federal equity positions a little bit just because they're really interesting. MP Materials is a really interesting one in that the federal government takes an equity stake, provides a loan through the Department of Defense, provides a price floor, and guaranteed offtake. So if you look at those 5 challenges on my first slide, this hits a lot of them with let's say, direct federal intervention. Lithium Americas got this 23-year term DOE loan. And so again, you see that the length of the project coming into play here. One other, we've heard a lot about Perpetua, which is a really interesting one. That was one of the first investments that JP Morgan's fund that's specific to reshoring manufacturing took a bite of. And then we see a variety of acronyms here getting involved in the space, including TechMet, who we heard from a TechMet subsidiary earlier today. So these range again from just equity like this Atlantic Alumina deal, equity and debt like USA Rare Earth, governance only. So we've seen a variety of federal investment. I pulled these numbers from a Cato Institute study, but they found that 30 companies now have the federal government in some form as an equity holder in them, and 19 just since December. And what it means quite often is you have the federal government acting as regulator, customer, financier, and shareholder all at once, which is kind of an interesting position to be in. Cato is sort of outlining that what we have is kind of a pseudo-sovereign wealth fund assembled deal by deal, and that has caused some people to suggest, the Trump administration has suggested we create a U.S. sovereign wealth fund, and some people have suggested perhaps a U.S. sovereign wealth fund could be a vehicle to roll all of these investments in, and also be a vehicle to create a strategy around investing in strategic industries to the United States that would give us maybe more of a coherent and predictable approach. And by some people, I mean me. So that middle one is, that's a paper that I published. It's my most recent publication, is on a U.S. sovereign wealth fund and how that relates to critical materials funding. So that has been something that has been looming, though. Chris said it really well. If China wants to do something, just write a check and do it. We really don't have any mechanism that's equivalent to that in the United States. So something like a U.S. sovereign wealth fund could possibly provide that type of opportunity. But it's just a little bit of a recap here, and then I'll pause for questions. Is the range of people and investors we've seen and funders we've seen get involved in this space has changed a lot recently. We've seen a strong uptick, especially from private investors, and this is in part due to various efforts at the federal level that have made the investments look a lot more appealing, but a lot of capital is still needed, and it's going to be a fairly long build out, and so there's still a lot to be done in the space of funding, especially attracting private funding.
Thank you for that. I know I'm a nerd like you when it comes to finances. Have any of these strategies been tested legally as they've been going forward?
So I kind of glossed, I went the wrong direction there and messed it up, but I kind of glossed over this, but Cato specifically has questioned let's say the legality of these various U.S. Equity holdings. So I'm thankfully not an attorney, so I have no idea how that will how that will shake out. But it's very ad hoc, I'll say, and unprecedented, clearly. So we'll see.
Sorry, folks, we're blessed with a big room.
Very much a big room. Thank you very much. Very good stuff. I'm a mining engineer, but I really like this stuff. But just a more of a general government question, if you will. Isn't buying or taking over parts of public companies kind of like socialism or communism? I mean, I kind of think that, but maybe I'm wrong.
Well, it's certainly, as I was trying to dance around, for a variety of reasons, more or less unprecedented in this country's history. In many other countries, they have sovereign wealth funds that support domestic investment, including equity. But in this country's history, we've not had this. Actually, my paper was exploring what the governance of that would need to look like for, let's say, us to trust such a fund, that it would stick to a mandate over, let's say, multiple election cycles, et cetera.
This is great stuff. I hope to see a paper in the future that's a look back on how things worked out. I'm really interested in
other analogs outside of China, and to see how we did, and or if there's a rubric we can come up with that's not picking winners, and if you have any thoughts on if we're picking winners and how that looks.
Yeah, it's a good question, and on the picking winners question, to me, one of the key kind of governance issue is who gets to, if we are going to pick winners, who gets to pick that, and who determines which of all the critical materials and all the critical firms, which are the most critical. And you hear other things quoted like return on, I skipped over some of these, but taxpayer return on investment is a criteria that the Commerce Department has applied, which is an interesting framework, let's say. Not one we're not used to hearing, let's say, like what kind of return are we getting on the spend, financial return, not, let's say, other types of return.
Please thank me in joining. Please join me in thanking Dr. Mauck.